You're welcome back. Of course, you're still watching Business Morning here on Channels Television. Well, also yesterday, the Central Bank of Nigeria, no, that was before yesterday, raised interest rates on Naira savings deposits to 30% of MPR. In September 2020, the Central Bank, as part of efforts to mitigate the impact of COVID-19 pandemic, had slashed the minimum interest rate payable on Naira savings deposits from 30% of MPR to 10% of MPR. Well, the bank had explained that the move was aimed at stimulating growth in the larger economy following the economic slowdown caused by the pandemic, and now it's back to 30% of the MPR. But what does it really mean? What does it mean to your savings? What does it mean to liquidity in the country? We have Ayodiji Ibo, Managing Director of Optimus by Afrinvest, joining us for that conversation. Good morning, Mr. Ibo. Good to have you on the show. Been a while.
Good morning, and thanks for having me. Good to be here.
Yeah. Okay, so before we go to this, the one on the savings, let's talk about well, I won't say hike, I would just say reverting to the former interest rate on intervention facilities. So because of the pandemic, according to the CBN, they wanted to make it easier for people to access and also pay back. Now it's back to 9%. What does it mean really for businesses? I think they said from the 1st of September, the new ones will start paying. From the 1st of September, we'll start paying 9% per annum. But what's the implication of all of this? And can we say that we felt the impacts, you know, of the slash in the interest rate in the period that it was slashed?
Okay, thanks. And it's what the CBN did. I think it is in line with what we are also having in the global space. So during the COVID-19 pandemic, the impact to reduce that impact on businesses, reduce the interest rate on the intervention funds from 9% to 5% for a year, and it was now extended this year. It was supposed to lapse in, I think, in March, and was extended again for about 6 months. So what the implication is that the cost of funds, that's the interest expense, or I would say finance cost for the companies would go up. So a lot of these companies that have benefited would have been positive for them, because when you look at the spread, that's about 4% savings that they would have paid, and that's very significant. I know some sectors, some companies within the agri space that quoted and assessed it. That was also positive for them, because it was one of the cheapest form of funding that I think is available in Nigeria. So it's positive, but in terms of looking at the holistic impact, there's really no data to show that impact assessment, which would also be very good if the CBN can also carry out this, that we're able to see that impact. But looking at the total intervention fund at the proportion of GDP is still very low. CBN is playing its role, but there's a limit to what the CBN also can do, or the impact they can make. Their main focus is monetary, and coming to also play a bit of the fiscal side, it's also commendable.
So, I mean, I guess it's important to also know that this is for the intervention facilities that the CBN makes available, you know, to different categories of people. But at a time when inflation is actually really high up there, we have the impact of the Ukraine war also affecting the economy. Some people are asking, is this really a good time to go back to the 9%?
Okay, thanks. I would say, yes, the CBN has tried for close to 2 years. And when you look at the other options in terms of financing in Nigeria, you would see that the 9% at the single digits rate is still very positive compared to other options of financing. Currently now, for corporates to even issue commercial paper, you would have to, for the CP or for the offer to be successful, it would, even for a 270-day instrument, you may have to raise it up to like 16–17%, depending on the rating of the issuer. So I think that it's positive, and it is a form of, I would say it's also a form of subsidy. So it's also always good not to overdo it. For those that have enjoyed it and the benefit, I think it would have accrued to them. And in terms of economy have rebounded, and that should not be a problem to companies that have assessed it.
Yeah, but companies are paying very high for energy now, among other things. So, I mean, if you say the economy has rebounded, some people will say, I mean, we're having crisis also.
Yes, but I think that what we should look at is beyond trying to rely just on the CBN, there's a major role that the fiscal authority needs to play in this. The private sector, the corporates should be able to raise capital within the economy. If the environment is conducive enough, if cost of doing business is reasonable enough, then it will be easier for a lot of these corporates to be able to access capital within the economy and not just rely on the CBN. There's a limit to what the CBN can do when you look at the total amount of intervention funds relative to GDP. I think it's still about 5 to 6%. So it's still very, very low, and there's a limit to what they can do. You're also aware of the ways and means, the support that they are also giving, about 17 trillion based on current amount to the government. So there's a lot that the CBN is doing regarding intervention and support for the economy.
Yeah, I know that ways and means has been a major conversation, that it's getting really high. But let's also look at the other circular that the CBN said that interest rate on savings is now 30% of MPR from 10%. First of all, help us with the calculation. This is 30% of MPR. Formerly it was 10%. So what does it amount to? What's the percent?
Okay, thanks. I'm putting it in basic terms. Currently, MPR is 14%, and it has been moved from 10% or 14%, which would have been 1.4%, now to 4.2%. So it means that, and that's just the minimum, but some banks pay above that minimum. So on the amount, any amount in your savings account, there are a bit of rules for some of the banks that maybe if you withdraw from that account more than 4 times in a month or more than 2 times in a month, you may forfeit the interest. But for those that have that funds there and you have not touched it within that month, it means that the interest you'll be getting annualized is 4.2%, which means that you'll be getting higher return on that's more than 100% increase when you look at it in absolute times that you'll be getting on your funds. And to also look at why would the CBN be doing this at this time, you would recall that also as a form of palliative or support for the economy, and to also increase spending. So what typically happens is that when interest rates are very low, it's a disincentive for people to save. People spend more. So as a result of trying to spur demand in the economy, the CBN brought down the interest rate. But now you can see that the inflation is high. CBN is trying to see how it can curtail spending in the economy, though I don't expect this to have much impact on inflation due to other factors that is currently impacting inflation, in addition to also the increase in money supply to the economy. But by and large, when you look at it from the investor's perspective, it's more money for you, more than 100% of what you got last month. I think the effective date, I think, is from next month. So you'll be having more than double of the return that you are getting on your investment.
Do you see this doing anything to inflation?
No, I don't see it having much impact on inflation because when you look at other factors that are really impacting inflation, we talk about it's more of cost push and not a demand pull. So cost push meaning that when you look at the cost of doing business is high, there's the impact, the imported inflation, impact of effects on the production is also impacting on prices. Insecurity, agri sector plays a major role, and farmers are unable to farm, and when the amount of production is also reducing. So when you also look at energy prices have also gone up. So these are things that it's not just a reduction in demand would solve. So it's more from a lot of structural issues that needs to be focused on. But it's why I would say looking at it from the investor's perspective, inflation rates currently at 19.68%, that's as at July, and with 1.4%, you will see that the negative real return is very significant. So now increasing it to 4.2% minimum, it would have impact on all other rates, and investors will be able to enjoy better return and be able to bridge that inflation gap. And once investors are able to get better return, it's also likely that we would also see that reduction in speculation on the exchange rate, because most times it's also a game of trying to reduce the negative impact of increase in prices on their savings and investments.
But you know, at a time when liquidity is really squeezed, I'm asking myself, do we really have people who would want to cash in on this? Because dealing with the basic needs is like taking all of the liquidity that is available. So do you have people who want to look at savings because they know they can get 4.2%?
Okay, thanks. Yes, there will be people that will look at that. You know, most times, once interest rate is almost at the zero level, there's no incentive. Why do you want to keep the money in the bank? Why do you want to save? Most people would prefer to spend, even with high inflation, because by the time you continue to keep it, the cost of the prices of those goods will continue to go up. So what this basically that we would see, yes, the liquidity level is tight, which is the reason for that. We all know about the discretionary cash reserve ratio, the discretionary debits that also goes on within the financial system. That is impacting system liquidity. So it's a different problem entirely, which needs to be looked into. But looking at it from the investor's perspective, I can't be keeping money at 1.4% per annum when inflation rate is at 19.6%. You look at the Nigeria Treasury bills rate, the last one closed at 7.4, 364-day instrument closed at 7.45%. So what we would see is that with the base of inflation rate, all other investment rates will also increase. Deposit rate, that's placement rate, will also have to go up. For the portfolio managers, investors will be demanding for more rates. So if your mutual fund is returning about just 6%, is returning about just 5%, investors will prefer to just put it in savings, keep it with the bank. So what you would typically see is that even portfolio managers will need to look for products that will give them higher return, so that there's that compensation for investing in mutual fund relative to keeping your money without doing anything in the bank. So it will cut across. We'll see that impact even on fixed on bonds rates, because it's like a base that will be set. And lastly, the lending rate. We would see that lending rate, which would be negative for businesses, will also increase, because when you look at the way lending rates are set by the bank, there's always a minimum spread that they need to also have. So with that minimum spread, I'm collecting money from someone at 4%. We'll also recall that there's that CRR element, about 25% that goes to the CBN, that I won't be able to make money on top. So when I look at that, I look at other fees, the NDIC fee that will pay, the AMPON levy that will pay. All those things would be factored into building and having a rate. So we would also expect that both the maximum lending rate, which is for those that are unsecured or have low credit rating, and the prime lending rate for the blue chip companies would also move up, which will be negative for the businesses. For the banks, cost of doing business, cost of funds would increase, but it will be compensated for based on the loans, and also increase in investment securities that we expect.
Yeah, okay, Mr. Ibo, just before we let you go, FX has been a major issue, you know, for manufacturing, for businesses generally, for the aviation sector. Does this help in any way?
No, this really doesn't have to do with the help with the FX challenges. Yes, what we typically, like I mentioned earlier, is that there may be a reduction in the demand, but because the supply of FX is like, it's like a drop in the ocean, so you will continue to see that spread. And there's now an incentive for people to run trip. You have the official rate at 430 naira to $1, and you have the parallel market rate at almost 700 naira to $1. So that's an incentive for people to run trade, for people to speculate on the naira, for people to even divert rather than collect the dollars and do business at the 200 naira spread or almost 300 naira spread. People would prefer. The return is significantly higher than even doing the normal business. So these are some of those things that also need to be looked at so that there's a bit of stability, because there's that impact of imported inflation that we always see on inflation rate on prices of goods, and which will impact on standard of living.
All right, Mr. Adejebo, MD at Optimum by Afrinvest. Thank you so much for sharing your thoughts with us this morning.
Always my pleasure. Yeah. Thanks for having me.
Yeah, well, obviously, when it has to do with FX, we just have to deal with the issue of supply. It doesn't look like we can run away from that. Well, that was the CBN conversation. We have another conversation coming up. And, of course, that will be from the commodities space. That's after the break. This is Business Morning on Channels Television.